Welcome, everybody. For those of you who don't know me, my name is Sapna Shah. I'm the founder of Retail X Series. I'm an angel investor focused on the future of retail. Hopefully you're here because you want to hear more about fundraising in an uncertain environment. Our guest today is Robin Lee from GGV Capital. She is a VC, and she and I are going to kind of have a chat about some things that we're seeing in the market today in terms of fundraising. Especially focused on kind of early stage. So I think most of you are probably pre-seed or kind of seed stage. We'll be talking about that. We'll be taking your questions through the chat. So after we kind of sort of finish our remarks, you can put your questions in at any time, but I'll read them out. And we can take any questions that you have. This will go till about 2 o'clock. So we've got about an hour. And before we kind of get started, Robin, do you want to introduce yourself?
Yes, thanks, Sapna. Really excited to be here today with everybody. Thank you for having me. So I am a principal at GGV Capital. We are a global venture capital firm. So we've been around for about 20 years, mainly investing across US and Asia. So we have offices in Menlo Park, San Francisco. I'm based in New York. We also have Beijing, Shanghai, and Singapore, and that covers kind of our global footprint. So out of the Americas, I cover US and Latin America. Singapore covers Southeast Asia and India, and then China covers China. And so we act together as one fund and make decisions as one fund. So, and in terms of investment areas, mainly multi-stage and across 3 different verticals: consumer internet, which includes e-commerce and the e-commerce ecosystem, to social media and digital media. We also have enterprise SaaS, as well as frontier tech, which is more deep tech, AI, robotics, etc. I focus primarily on consumer internet and urban tech. And we invest across all stages. We manage about $6.2 billion and actually invest anything from seed to late stage. So really excited to be here, Sapna, and I know we've known each other for many years now and have worked together quite a bit. So happy to be helpful in any way I can. And we have about 30 portfolio companies in New York City, and continue to make more investments as well.
And I guess I should also mention that you also spoke at an in-person Retail X session. I want to say it was last year, 2 years ago. So this is not your first Retail X kind of exposure.
Yeah, that's right. And
great.
a very active mailing list. So thank you for all the resources you always send out.
Yeah, and I will continue to be doing that. So and this recording will also be sent out as well, or at least a link to it. So for those of maybe for everyone kind of in the audience, if you've got friends who weren't able to make it or are looking for more of this kind of information, feel free to send out the link and I'll send it out after this session. So Robin, I want to start with, are VCs investing right now? We see on Twitter, people say, you know, we're open for business. Like, we are still looking at new companies. Is that really true? Is that happening right now in the short term, you know, kind of while most of the country is on lockdown or quarantine? Or is that really like, yes, we're sort of open for business, but maybe not right at this moment?
Yes, I think, you know, if you asked me this question a week or 2 ago, the answer might be different. But I think, you know, it's been about 5 weeks now where, you know, a lot of us have been working from home, at least the ones who are lucky enough to do that, and most of the venture firms. And so I think in the very first month, it was really kind of reaction about how do we kind of get our portfolio in line? What do we do during the COVID era? And like, how do we transition and take a pulse check across our portfolio? And so I would say we probably were making investments, or most people were not at that time. Now it's a little bit different. We actually have seen companies, even in our portfolio, get term sheets. So definitely happening. And across all stages as well. So we are actually about to invest in a Series A and with 2 other institutional funds as well. So definitely new companies as well as existing portfolio companies.
And when you say new companies, were these companies you met with in person at some point before all of this happened, or are they companies that you're now meeting with virtually and then able to use if that's built enough of a relationship to actually like write a term sheet or make an investment?
Yeah, I would say that this was somebody we have known since last year. And so we ended up not investing in the seed round and decided to invest now. And based on like a recent catch up, as well as a lot of, there's still a couple, you know, I know this is a question for later, but there are certain areas that are very hot right now given COVID. And so those are the ones that are taking off and getting a lot of investments. And so,
and do you think like if, you know, for founders who are on this call, if they're meeting, like, let's say they're meeting with you for the first time next week, but obviously that's going to be virtual. Do you have to have kind of that in-person experience to really get to know them before you feel comfortable enough to make an investment?
I don't think we would actually need to have the in-person, but I would say we probably would need to spend a lot more time together, probably getting to know each other through like your virtual meetings with you, your team, probably a lot more diligence there, and a lot to understand, maybe more references from you and people who know you, because if it's such a short period of time, it's really hard to kind of get to know one another, particularly if it's just virtual.
Yeah, and I think, you know, as it already, you know, I think we're already hearing from founders that even kind of getting the meetings right now is taking longer. To your point, sort of when all of this work from home started, I think people were, you know, trying to figure out the new normal, right? Of like, okay, I'm home, I have kids in my house doing online schooling. I don't actually have a desk, and, you know, I need to like figure out where I'm going to be working from. I'm actually sitting at my dining table right now, so I still don't have a desk. But, you know, I think as some of those figuring out the new normal has gone away, do you see kind of more ability to focus on new companies versus sort of the existing portfolio, and then this whole trying to figure out the rest of your life?
Yeah, it was definitely, we were not taking pretty much new meetings 2 weeks ago. I'd say last week and this week, I just started opening it up in terms of kind of time slots and able to meet kind of intros made from friendlies. I think that's actually really important at this point in time, right? Cold emails are really difficult, even pre-COVID. And I think now, you know, we definitely want some warm intros because we can't meet face to face, right? If there is somebody that we know in our network that, you know, already, that makes a huge difference.
Yeah, that makes a ton of sense. And I just am gonna chime in here now from the angel perspective, since you're sort of giving the VC perspective. I think what I've seen with angels is really quite different, is that angels are still not open for business, for new business, I think, for the most part. I think what I'm hearing, certainly from a lot of my angel friends, is deals and companies that they had met with pre-COVID are still, you know, they're still kind of in process with those. But it is really hard to think about new companies just because as a percentage of your total portfolio, you know, I have a portfolio that includes sort of public investments, real estate, and then sort of illiquid assets, which is VC investments. And, you know, I'm the LP in a fund, a couple of funds, and then also my startup portfolio. And now I have too much in the illiquid side versus sort of the other, you know, where there's been market gyrations or valuations have come down. And so I'm hearing from a lot of angels that, you know, they're not quite open for business yet, which I think is really difficult at the early stage, the pre-seed and seed. So it's nice to hear that at least, you know, from a VC perspective, I think having that channel at least open up a little bit more is helpful when angels are a little bit fewer and farther between right now.
And I think that also, if you know, as you're doing some research for founders, as you're doing some research about which funds to talk to, keep in mind, I think the size of the fund matters a lot too, right? So a lot of the funds who are operating out of, hundreds of millions of dollars in assets, for example, we're investing out of Fund 7, which is almost a $2 billion fund. We started investing out of that fund last year. So we definitely have a lot more dry powder and a lot more room to make investments, right? Whereas if you're going to a fund who maybe, a $50 million fund or $100 million fund, and they've been investing out of this fund already for maybe 2 years or a year and a half, then there's not that much room for them to make more investments. So they'll be hesitant to make investments during this time, particularly when they have to take care of their own portfolio, right, as well.
Right. Is there a concern at all on that, like you've raised the fund, but maybe all the capital commitments from the LPs haven't come in yet for that fund? Is there a concern at all that, that not necessarily for GGV specifically, but overall for VCs that, have sort of closed on a fund, they've gotten some portion of it in? Is there a concern that LPs will pull back and so they don't even really have as much dry powder as you think they have?
Yeah, I think I've certainly hear that in the market already, right? There are funds who are doing a first close, can't do their second close, or they are worried about their LPs. And I think it also depends on your LP base, right? And so a lot of ours is pension endowments, et cetera, which tend to be pretty fine, but definitely others who maybe their LPs are family offices or their LPs are, wealthy individuals or whatever it may be, that certainly makes a difference, even if your LPs are corporates too.
Yeah, that's a really good point. And I think a lot of times founders don't really understand that there are different kinds of LP bases, and this whole point of when was that fundraise and how much has been sort of deployed out of that fund and how much is left is sort of important research to do as you're kind of going through the fundraising process in good times and bad, honestly.
Yep.
So
sure.
I want to shift over to, you sort of alluded to this, that there are some hot areas right now. So what are those kinds of hot companies or hot areas right now that are interesting to venture capitalists?
Yeah, I think if you think about what, is happening with COVID, what are the sectors that they are enabling to kind of start thriving is one. Definitely you see e-commerce picking up quite a bit, particularly in both like staples as well as food delivery, grocery, definitely in the B2B space as well. So logistics for e-commerce, payment for e-commerce, services for the e-commerce world. We have one that is focusing on supply chain optimization. So they're getting more clients than they ever had before, right? Because of the COVID era. And so that in the ecosystem for e-commerce is definitely very interesting. We've definitely seen a lot of both inbound requests to our portfolio companies to fundraise. And we are also looking a lot more into this space as well. Another area that, we're actively looking in is productivity tools, right? And work from home. We have some in our portfolio that work very closely with Zoom and in the Zoom ecosystem. That is certainly picking up a lot of usage. Otter.ai would be an example where they provide a lot of the video and audio transcripts for people who use Zoom. And so, that given the kind of wide adoption of Zoom happening in the past few weeks, they're definitely benefiting from this curve. So any of these B2B productivity tools, self-serve ones, definitely are very exciting. And also online tools for maybe video conferencing or virtual events, et cetera, as well. And then lastly, telehealth is definitely a hot area. And so we're definitely seeing a lot there.
Yeah, it's interesting that, some of the things you mentioned around e-commerce, a lot of the founders in the retail ecosystem prior to this COVID kind of catastrophe were working on a lot of retail tech solutions for omni-channel or for store employees, or getting data from stores, which obviously since all the stores except for grocery stores are essentially closed, they're kind of thinking about like pivots or trying to figure out what to do right now, because obviously they can't deploy store technology at this point. But do you think those kinds of categories are going to come back as soon as stores open up, in terms of VC interest into those categories? Or do you think that the hot categories today continue to be the hot categories for a while, and it'll take a while before these sort of things that don't work in a COVID environment are interesting to investors?
I think those that focus primarily on in-store may have a little bit more trouble, even post-COVID, because the retailers themselves have to figure out, one, what to do with all the remnant inventory that is sitting in their stores today, right? Then there is their own profitability and bankruptcy issues. And so they also are furloughing and cutting salary for all of their staff, right? TJX just announced hundreds of thousands of employees being furloughed, and then everybody on the executive team taking pay cuts. And so you're going to see a lot of that trickle into services that they can acquire later on as well. And so if you are looking for them to be a buyer of your technology, I think post-COVID, it will still take a bit of a time for that to recover, especially a lot of the stores today that are closed will likely remain closed for good, actually. Not all of them will be able to come back.
Yeah, and I think it's interesting. I completely agree with you. I think it's interesting that we're going to see, I think that a very massive shift in sort of the retail landscape and kind of what brick and mortar looks like, what shopping malls look like, what these legacy retailers look like. And I think it's going to be 100% of what you said. It's going to be a tough sell for technology into some of these enterprise companies for a long time, because they have to start, if they can even reopen, they have to pick up the pieces of kind of all the things that have gone wrong. So kind of getting back to the fundraising piece of things, what do you think is going to happen to valuations at the early stage? I think we've seen over the last, certainly I've been investing for over 6 years, and valuations at seed and pre-seed have gone like this, and the round sizes have gotten bigger and bigger and bigger. Obviously, I think everyone thinks that there's going to be kind of a big correction to that. But where do you see kind of early stage valuations going?
So definitely taking a hit. The ones that we do see inbound in terms of fundraising or term sheets that we're both issuing as well as getting for our portfolio, in good times, we would probably see a premium. Even now, even if they're doing well, if they're in like the food space or in the e-commerce space, they're probably still hitting a valuation that's 30% less than what they would normally get. So while you may still be able to fundraise, that cap has changed as well. And then in terms of those who, need additional cash runway, and we're recommending about 12 to 18 months of cash runway, people are opening up their previous rounds, but likely going to be around the same price.
Right. So if you're opening up, if you're a company that you've already invested in, you're opening up a more, space in a round at a previous price, and now you're, and as an investor, you're looking at that. So something that you're already invested in, you already know the founder, you already know the team, you know the business, and then you're looking at a new company that maybe has the same valuation, but is obviously completely new to you. I mean, it seems obvious to me where you're going to put your dollars, right?
Yeah, I think yes and no, because when we are looking in our own portfolio, it comes from a different pool, right? It comes from the reserve pool that we may have set aside. And so that's an allocated amount of money that, hey, we're going to use this money to support follow-ons or additional increments we want to put into a company. So we're actually looking at that as a whole group. We're not actually looking at one by one basis in our portfolio. So I know, hey, I have 5 consumer portfolio that might be affected, but we're actually looking at the overall health of the entire GGV portfolio of over 270 companies, and be like, which one should get what and why, right? And what does that look like in terms of returns for us? So that really comes out of a reserve pool of money. And then in
Mm-hmm.
terms of new money that we want to deploy, we would still allocate that, I think, to new deals. Although I would say we're definitely not in a rush to make new
Right.
deals happen.
Right. Fair. So what can companies do now if they can't raise and they, are out there, maybe they started their raise pre-COVID, they're not finding any traction, maybe because they're in one of these categories that just right now is not a great category. Travel comes to mind as a not great category. What should they do? Should they just pause on fundraising and hope that it gets better, pivot the business to try and get to a place that they can fundraise? Like, what would be your best advice for founders?
I think, if you're very early stage, I would probably not recommend mothballing, which is just try to conserve all your cash and then wait till this blows over. I think, at such an early stage, you do have the opportunity to pivot in a way that you're not probably, laying off so much of your staff and like trying to make to a completely new business model. You mentioned hospitality. Airbnb is one of our portfolio companies. And, for them, they're obviously very impacted by the COVID crisis because no one is traveling, no one's taking vacations. So what can they do differently right now and pivot their business? So one, opening up online experiences, right? You can't travel, but maybe you can connect with an experience in London and watch a magic show, right? In your own home with other people. Or they're pivoting to long-term rentals because people need to move away from New York City and need a place to stay right now, right? So they're probably not looking for something for vacation or short-term, but they need a different solution. And so thinking of what you can do right now to pivot and a lot of times could actually end up being a better business for you over time. We're actually seeing that in companies in the food space, right? Previously, they were selling mostly to restaurants, but now that a lot of the restaurants are closed and only doing delivery, that is a huge impact to their business because the supply chain has shrunken. So they're actually opening up to direct to consumers and getting goods to the hands of people instead of restaurants. And so I think there's definitely opportunity to think about what you can do in the new COVID era, and likely that might even stay as habits change.
Yeah, I'm so glad you sort of mentioned the pivot thing, and you also alluded to content with Airbnb. And I think what I'm seeing a lot on consumer companies right now at the early stage is that, fine, nobody's going to maybe buy your product necessarily if it's not sort of an essential one right now, but there is a lot of content that people can provide, and whether that's, a webinar on styling your hair, whatever that category is, there are a lot of ways to still engage customers, even if they're not 100% purchasing today. You can certainly build your funnel and find different ways to create engagement so that you're not just doing nothing and mothballing, to your point.
Mm-hmm.
I also kind of want to go back to one of the things you said about if you're not fundraising right now and you sort of do, and you're not so early that you're still a little bit of a side hustle, but you actually have an ongoing business. You mentioned sort of a runway of kind of 12 to 18 months. I think other people I've talked to have said runway through just December because they're hoping 2021 is better. Why are you sort of thinking about the 12 to 18 month sort of cash runway?
Yeah, I think, if you think about a cash runway for 12 months, you would probably start going out to fundraise in 6 to 9 months, right? You would not wait until the end of the 12 months to start fundraising. And so if you think about, what will we look like 6 months from now, that's already the end of the year. Could VC money pick back up or angel money pick back up? Maybe if COVID doesn't come back, right? But I think it is unlikely that everything will return to normal, in August or September. We just don't see that happening. I think we saw, in Asia where you do have a lot more extreme measures in terms of government helping on the quarantine and then reopening different areas of the economy, it still takes a bit of a lag time. China is probably about 60 to 70% recovered in terms of our portfolio's business. And so that, and we're in the US much more behind in terms of how we're dealing with the crisis or getting tests out to everybody. And so because of that, I think, the guidance that we're giving is you need to have a bit more time. Also, what we're seeing is while you may be making revenue, if it's not direct to consumer, if you're selling to enterprises or you're selling to businesses, we're seeing a lot of payments being delayed. So people are coming back, renegotiating contracts with you, right? Or they're negotiating with you, hey, can we have another month or another quarter to pay? And so you're going to see a lot of that delay. So if you don't account for that today, I think it would be hard for you to figure that out later on and have that to answer for your fundraise.
Yeah, that's really helpful perspective. And I think, thinking about how long a raise takes, how long your cash is going to last, and then a little bit assuming the worst, assuming that, things don't go back to normal in July or June or whenever people think it might go back. I have one last question before we turn to Q&A, which is, if you're fundraising, you're in a category that is interesting right now and you're doing well, what are your tips for kind of virtual pitching, right? And what advice would you give to the founders who are listening to this and thinking about how they have to adjust their pitch from an in-person pitch to a Zoom call or a FaceTime?
I think one thing I found very successful is having recorded demos and having tools that you can share to show what you have done instead of using that time during the Zoom, right? It's actually even better than pitching in person, because in person you may have to whip out your laptop or your iPad, but if you can send a lot of these elements ahead of time, we actually really appreciate it. So yesterday we had a call with a founder and she gave an update to us, but she sent a video ahead of time and she went through a demo of her product pre-recorded, right? Something that she would show her clients as well. And we were like, oh, we didn't have to use any of that time to talk during the Zoom meeting because we already looked at it beforehand. And so saves a lot of time for everybody and also shows how prepared you are, right? Coming to the meeting. And so that helps a lot too.
I love that advice. I think that's great. It is funny because the advice historically has always been when you're pitching a group of people or something like that, don't do a demo because it never works, right? It never, the link never works, there's Wi-Fi problems, whatever. But this is the perfect case where you can just record it ahead of time and just send it over and you can actually do a demo now. So it's the exact opposite maybe of advice people have heard in the past. So I appreciate that advice. So thank you. I want to move to Q&A because we have a couple of questions already and everyone can put their questions into the chat. I'm going to read Levi's question first, which is, in a $1 to $2 billion fund, how much of that is allocated as dry powder without the firm having to make additional capital calls to LPs?
So the way that we make capital calls is whenever we need to make an investment. And so, when you raise a fund, it's not like the entire fund's capital is deposited into our, bank account. And so whenever we make a new investment or follow-on investment, we would call capital every 2 weeks or, every the cadence that you have. So I'm not sure if that answers your question, but we'll always have to call capital.
So I guess let me ask a follow-up because maybe this will help clarify. So when you, let's say you raise $1 billion fund, is there a pre-set timeline of capital calls, or is it as needed?
It is as
typically
needed, typically.
Okay.
Though we are investing in a cadence, right? So
Right.
Our LPs are very mindful of, hey, don't deploy half the fund in the first half year, right?
Right.
So we always have to, internally be mindful of how fast we're allocating dollars. But no one is going to complain and be like, you're not deploying money right now during COVID.
Right. Got it.
I actually do want to say one more thing that I forgot to mention earlier when we talked about pivoting, is actually try to think about who you can partner with at this point in time. So we had this, so I host a weekly town hall for our portfolio. So every Monday morning, about 50 to 70 participants in our portfolio, senior CEOs or senior leadership team, come together and talk to one another. And if you can have access to any type of forum where you can meet other founders and come together and talk or share knowledge, would be really great. Because one thing that came up was, hey, we have a company that enterprise company that sells to IT professionals, for example. Traditionally, they would go to trade shows or conferences where they would have to, get sales and leads. But in a COVID era where no one is traveling, what do? So they're actually partnering with a lot of other companies to make a bigger reach, do more webinars, and actually spend the amount of money, maybe a fraction of the money they were going to spend on a trade show or travel, but to use it for prizes or use it for giveaways to attendees. And so they're actually giving away 100 Eero Wi-Fi systems for the first 100 participants that come and join the webinar, right? And so, can you team up with other people that have the similar audience as you in this point in time, and reach a broader audience, combine together and have a lot more synergies, or even find ways to work with one another. I think a lot of the even retailers who are still open, whether it's Walmart, Target, Amazon, are having a lot of conversations with companies to leverage them at this point in time as well.
Yeah, that's a great point. And I think you can even partner at the very earliest stages, because I think a lot of founders are all kind of in the same boat. And one thing I've done to maybe help founders on this call is everyone should have gotten an attendee list ahead of time, so you know who's on the call. So take a look and see if there's any interesting partners in that list. Okay, the next question is from Eugene. Any interest for virtual try-on technologies? And I'm assuming, Eugene, that you mean, is there investor interest for something like this right now?
I think, the answer is yes and no. I think, the question for me when I look at technologies that are virtual try-on is it a product feature or is it a standalone company, right? And so is it something that people can build, or are you going to be a big business over time? And what would that book of business actually look like? And what would your ultimate, exit outcome be? So that's kind of my answer to virtual try-on. I think, it's obviously something that is very important for e-commerce, and especially now as that continues to grow. Apparel is already pretty much one of the largest categories in terms of e-commerce penetration. And so, is there that much opportunity left there? Or, if not, is it more AR oriented, or is it more, virtual goods oriented?
Yeah, and I just wanted to add something to that, which is that I think, and I'm sure this is true of you, Robin, but I can't even remember the number of pitches that I've gotten on virtual try-on. I think it's a really popular space in the startup world. And so I think it's good to be mindful of the fact that I think a lot of investors have seen a lot of these pitches and have seen sort of the good and the bad, and have kind of gone through, tend to have a point of view on things like this. So in these sort of hot spaces, I think it's good for founders to realize that, you've probably seen all the competition, you've probably seen all their decks. It's really important to say what is really unique about you and why is yours going to work when all these others won't. It's really
That's right. That's a good point.
The next question is from Casey. Should founders be pivoting their pitch if a specific feature of their tech is thriving during COVID, and mention what else you do? Or should we stay on the original structure and just have a slide on why you're growing right now? Oh, I see. So Casey, I think your question is more about what you put in the deck. So if you've got something that's really working during this time, but maybe not the rest of it, do you really focus that pitch on what's working now? Or do you talk about the entire vision and then have a little bit about what's working right now? What's your take on that, Robin?
I think we actually had a board meeting this morning. We're talking about this exact question because we're thinking of adding in additional capital to the company. And I think it's actually really exciting to be able to talk about the specific feature of your tech that's thriving. And when you do want to raise, you want to be raising on maybe a project or initiative, right? And so the raise and the use of funds should be going towards something. And so if you're going to talk about, hey, I need this additional 500K because I'm going to build out XYZ feature and we need, 3 more engineers and 1 more product person to do that. And this is exactly why we need that now and why will put us in a better position for maybe our Series A can actually be a much better pitch than kind of your overall company, and then get to that specific feature that's working really, really well right now. Because right now, if it's working well, you want to talk about why it will be lasting and then how could that evolve over time after COVID as well.
Yeah, I love that point that it's hopefully it's not just a temporary thing that's only going to work right now and it's not going to ever work again. But if it is working, then it is exciting to see pitches where you're like, yeah, the things are working. That's great.
Yeah.
Especially now. From Pat, what role will TikTok, Instagram, and Snapchat play in the future of DTC? That's a very broad question. Robin, do you have a point of view on this?
Yeah, I'm actually seeing, the numbers are off the charts, right, of just consumption of media right now. And that's actually going for every age group as well in terms of like who's spending time on these platforms. And, I had a chat with this company I'm looking at right now. They on Easter Sunday, they went viral on TikTok because some mom purchased their product. Actually, you could look them up. It's public. Good Fair is the company. They were featured in a WWD article, GOODFAIR. They went viral on TikTok because a mom bought a bundle on their platform, and it's apparel bundle, recycled clothing in the sustainability space, and they did 300K in sales in just one day because of TikTok. And so I think you will continue to see this happening, right? It's hard to bank on like, hey, is one of my users going to suddenly create a new trend for me, right? But like investing in these platforms by looking at, what are people saying about your company, if at all, right? And what is the earned media that you have? And then how can you leverage the influencers in these spaces to do more for you is definitely very important. One of our portfolio companies, Winky Lux, has been doing very, very well on TikTok because they're not just D2C on their website, but they actually recently moved to launching in Target. And so they're actually getting a lot of the Target staff who's so excited about their product, putting their videos up on TikTok and Twitter. And so that's driving a lot of their D2C e-commerce business as well. So I definitely think even, moving forward, you're going to see, these becoming very important platforms.
And I'll just do a little shout out, Robin, for you for the Evolving E kind of series that you guys run, which I remember the last one, which was sadly in person, and obviously there's not an in-person one right now, but talked a lot about this TikTok thing, which I thought was just fascinating. And I think one of the examples was MAC Cosmetics.
Oh, yes.
And like how much volume they were driving through TikTok, which, this was a few months ago, and it was astounding to me. So I think there's huge opportunities on these platforms still. So
yeah, that's a good reminder. I should put together another TikTok masterclass. If you guys are all interested, do it virtually. They are one of our portfolios, so I can make that happen.
Cool, very cool, excellent. Okay, next question from Amy. What can startups who are not actively raising right now be doing, if anything at all, during this time to engage investors for later?
Uh, Continue to send out newsletters or email updates. Be top of mind, right? I wouldn't do it like every month, but I would do it, every quarter for sure, or every month and a half, because you want to show some of the traction that you're making. And I've seen a lot of really successful email updates where people are actually putting down, hey, here's like some of the exciting things that I've been doing. Here's some of the challenges, and then here's some of the asks. So actually, like, investors, who want to continue to build that relationship with you, want to be helpful, right? And want to get to know like how you're leveraging people around you to be helpful. And then, ask some of them to be your advisors, or, give you some advice along the way. And that could be, definitely a good way to engage investors for later, because we don't want to get to know somebody like right when you're fundraising. I think that's like probably the not as good scenario.
Yeah, I was actually at a VC and angel breakfast last summer, I want to say, and there were probably like 30 investors in the room. And we did a show of hands of how many people who might have said no to a company or said they were too early or weren't sure about a company, but got those quarterly newsletters, later invested in that same company because they felt like they had been kept up. And it was like a vast majority of the room. Like, I think
Oh, wow.
founders put that list of, oh, I got to write a quarterly update to these stakeholders and I need to keep everybody posted. And I think that is sort of the last thing you want to be doing in your day, and you kind of procrastinate it, but it feels very valuable. I was shocked at the number of hands that went up in the room. So
yeah, I think, we're not perfect. Even if we really like you, we might have forgotten, right? Because the CRM or whatever we use, or, we just have so much, companies that we're looking at. I mean, I probably take about 10 to 13 meetings a day, right? Whether or not it's new companies, but you're just gonna forget, right? And so staying top of mind is always great.
Amy, I know you have a second question, but I'm going to go to somebody else's question first, and we'll come back to yours. From Janan, how can founders who operate in emerging markets fundraise with the expected COVID-19 long-term effects that are coming at a later date in those markets? I think the question is like, if you're operating those emerging markets, you're kind of fine right now, but COVID's coming. And so will investors be interested now knowing that you're going to hit a roadblock in those emerging markets?
Yeah, I think, I think it depends on which markets you're talking about. In terms of emerging markets, I think, Latin America's already hit very hard, as well as, India also, right? And so all of Southeast Asia as well. And so I think everyone's just kind of mindful with that built in already.
Fair, very fair. From Daniel, is the Evolving E community active right now, and is it open to apply, or is it a closed group?
It is active right now, but I'm trying to get it back up to speed since so I actually was on maternity leave after the last Evolving. Thank you. After the last Evolving E conference, and then COVID hit after that, and so we are doing a conference in June as the next event, as well as a masterclass coming up in a few weeks. And so, Sapna, I'll send the invitation to you, and then maybe you can kind of distribute.
Yes, I will. I'll share it with the group. So look out for that once I get it from Robin.
It will all be virtual.
Perfect. Even better. Okay. From Taylor, given that investors are interested in e-commerce at this time, does there have to be a tech component to be interesting, or is there interest in brands that can capitalize on new consumer interest due to the direction of the world at large?
I think for large institutional funds, it has to have a tech component for there to be interest in brands. I think there has been like a significant shift away from just investing in a pure D2C brand, just given the return profiles that we're seeing, right? Unless you are very, very profitable and can be, the exit outcome is definitely limited to a certain size. And so when you think about kind of the funds that you're pitching to, for GGV to return our fund multiple times, right, we need to have many, many unicorns. for it to work. And so, you know, that's why there's also been a shift away from just investing in brands, because the outcome of the brands, you know, are there going to be like $1 billion plus acquisitions from, you know, the big guys or the incumbents over time? I think it's even less likely now given COVID and what's happening to everyone's cash. So I think, you know, there probably needs to be much more of a tech component.
Yeah, I am so glad you mentioned that about exits, because I don't think that's something we talk about enough in the retail community, because there are so many D2C brand founders. And, you know, the problem is that if you can't exit at these really high valuations, you cannot raise that kind of capital, right? Because then your investors don't make the money they want to make, but also you as the founder don't end up making any money because you get so diluted, right? And one of the things we've talked about in another retail session, and some of the people on this call were on that call as well, was, you know, other ways to fund your D2C business that are not venture capital.
Yeah.
And that is everything from, you know, angels and smaller amounts, to debt financing, to inventory financing, to revenue share financing, lots of different ways to fund your business that don't need to be venture capital, particularly for brands, particularly if your brand is something that really isn't going to be a mass brand.
And I've actually seen a lot of acquisitions of brands, right? A lot of acquisitions of smaller Shopify or Amazon sellers, right? There's actually even companies for some reason raising money to acquire a lot of these brands. And so if you are one of these brands, it could be in your best interest to do that if you're doing well, right? To exit to a private equity shop or somebody who is building a portfolio of brands as well. Because, you know, the big retailers like Target and Walmart have come out and said, we're not going to acquire, right? And so then who will be the ones that acquire you over time?
Yeah, great point. Okay, from Erin, have you seen any best practices or any advice for virtual demo days? I have a demo day approaching through an accelerator. That's a good question.
Yeah, I think I've seen a lot of demo days where people are asked to like still go on a stage. I think that is really tough because in a video it's so small. So definitely if you can avoid that, like don't do that. And try to make the like presentations as least info as possible, because you want people to listen to what you're saying. And so if you have so much detail going on in your deck or whatever you're presenting, people tend to not listen to what you're saying. So you're either doing a lot of charts or something like that to showcase what you're trying to say, or you're just doing a really good voiceover, because a lot of these sessions tend to be recorded as well, and people might provide a transcript. And so just either do one or the other. Don't do too much information overload, both either verbal or information on a deck.
Yeah, I love that advice. I was watching a 500 Startups virtual demo day, and I have to say it is very difficult to pay attention to one after another. So also there is at your voiceover, the less monotone you can be, the more helpful it is to help, at least for me, to help pay attention. So that would be my advice. Try to keep the passion in your voice, mix it up. Jokes could be helpful.
Yeah,
yeah, exactly. Okay, back to Amy. What other industries outside of travel and in-store retail tech / services do you think will have a more difficult time raising during and even coming out of this COVID environment? Other tough industries.
I think, property tech is going to be a huge one. That is already being impacted right now, right? Investing in startups that work in the home building, real estate sector, anything that like people are spending a lot of discretionary income on, or, as well, like home improvement may have a tougher time.
I might add luxury to that. I think not like luxury like LVMH, Chanel, but sort of the luxury startups that are really trying to do things in the luxury apparel or accessory space. I think we saw that after 2008, you know, that conspicuous consumption really fell off the charts for quite some time. I remember Valentino bags marked down to 90%. And I think luxury startups will face that. Oh, it was, I wish I'd bought some of them. Anyway.
But you know, one thing that I forgot to mention that is an exciting category that we're seeing as well is professional development and communities. So a lot of people want to figure out how, like, especially working from home, how do you engage your employees? How do you help them develop? How do you retain your best staff? And like, we're seeing a lot of people investing in our portfolio. Like, we need to get coaching for our executive team, right? We want to figure out ways to help our managers and people at different levels. And so we're seeing a lot of that as well.
Oh, that's it. That's really interesting. And I think those are categories that do feel kind of, they were already a little bit on the upswing, right? And so they're more on the upswing now. Okay, I think we have time for one or two last questions. From Nina, what is your opinion on the effects of COVID on the beauty industry?
Mm-hmm. I think with Sephora and Ulta and all of those, you know, beauty counters at a department store that are not open right now, you're just gonna see a huge impact on what people are willing to buy online or just holding off, because, you know, traditionally people didn't want to try on color or something like that, foundation online, and are hesitant, are remain hesitant because of the return policies, right, in beauty. And so you already see fragrance down a lot because people are not going out and you're staying at home. And so I think, you know, unless it's something in a certain price point that is more mass and very easily accessible, and you want it for fun, those are probably the ones that will be good. And skincare and face masks is stay at home and kind of self-care, but people are going to wake up to, you know, how am I going to spend my paycheck, right? Especially if you don't have a steady one or your income is cut because of COVID.
Yeah, I'm really interested, and I don't have any investments in space, but I'm really interested in the hair color at home trend right now, right? Because you can't go to a salon and, like, you know, again, I'm not an investor in Madison Reed, but I am a customer. And I will say, I'm very interested to see if those behaviors change, if people get used to coloring at home and that becomes a bigger thing in beauty, or do people go back to the salon? Like, you have to go back to the salon for the haircut, right? No matter what you do at home, your haircut's gonna be terrible. But do you get used to this new behavior that is significantly cheaper because you've had to learn how to color your hair at home? And I think that's a really interesting category that I think might really, this might have been the making of the at-home hair color category. That's in the premium sense. Okay, last question from Marvin. How open are investors to B2B retail tech plays born out of COVID, therefore no track record to date, but with incredibly strong business case and compelling long-term prospects? So I think, Marvin, what you're saying is there is no traction, but there's a really good idea here that is born in this time. Robin, what do you think?
I may actually end up relaying that question to you, Sapna, because we don't invest in pre-launch companies, but you know, Taobao was born out of SARS, right, and from Alibaba, and so there's definitely a lot of interesting companies that are going to be made from this era.
Yeah, and I think I've said this before in some of these other retail sessions, is that I actually think retail tech has a real chance to finally take hold in lots of ways. Like, if you're, as we talked about, if you're doing kind of the store tech for legacy kind of enterprise retailers, I don't know that that's going to be great. But if you are providing new and better ways to shop in terms of retail tech, maybe you're focused on DTC brands that are coming back, or maybe you're focused on something else. It's hard to say without knowing, Marvin, exactly what you're talking about, but I do think there's a lot of opportunity. Do I think angels in particular are going to invest at pre-seed in retail tech with no track record right now? No, I just don't see it happening. I think it really, some level of traction, I think, would be important, at least in the short to medium term. Okay, that's all the time we have. Robin, thank you so much. This was wonderful. Really appreciate you sharing all your thoughts and experiences, advice to all the founders that are on the call. Founders, like I said, this will be recorded, and I will send out the link to the recording. We will have another retail session next week. If you are a beauty brand, that's the one you want to be a part of. And I hope everyone has a great day. Thanks again, Robin.
Thanks everyone for joining. Thanks for putting this together, Sapna. Have a great day. Take care. Stay safe, everyone.
Bye.
Bye.